Welcome to the deep dive. Today we're tackling capital structure.
Right, that's essentially the mix, the blend of debt and equity a company uses to finance its operations and growth.
Yeah, exactly. We've looked at sources covering different kinds of debt, short-term, long-term, and equity, like preferred and common stock.
And how it all feeds into WACC, the weighted average cost of capital. That's a big one.
It really is. Our mission here is to kind of distill the essentials, see why this funding mix is so critical for a company's health.
Absolutely. It's fundamental.
And just to kick us off, here's something interesting. If a company goes under, the bondholders, the lenders, they get paid back before shareholders, the owners.
That's a key difference, yeah. It highlights the risk profile. Choosing between debt and equity isn't just about getting cash. It's strategic.
How so?
Well, take debt.
Yeah.
Short term, you've got things like commercial paper, basically IOUs for quick needs, funding current assets.
Okay.
Long-term debt, think bonds. Debentures, which are unsecured, meaning no specific asset backs them up. Or mortgage bonds, which are secured by property. Even leases can act like debt on the books these days. It all impacts the financials differently.
Right. And then there's the other side, equity.
Oh,
Ownership.
exactly.
Preferred stock is, well, it's kind of interesting, isn't it? It pays a dividend, often fixed.
But it's not like bond interest. The board decides, and crucially, it's not tax deductible for the company.
Right. Then you have common stock. That's your basic ownership, voting rights, all that. Dividends are optional.
And common stockholders are last in line in a liquidation scenario. That's the trade-off.
So boiling it down, debt offers tax breaks on interest, but adds risk, like bankruptcy risk if you can't pay.
Precisely. Equity doesn't have that mandatory payment risk in the same way, but it dilutes ownership and is often more expensive overall in terms of required return.
Which brings us back to WACC, the cost of all this money.
Yes, the weighted average cost of capital. Think of it as the company's average cost for every dollar of financing it uses.
And it's like a hurdle rate.
Exactly. If you're considering a new project, you need it to earn more than your WACC to really add value.
So companies want the lowest WACC possible.
Generally, yes. The capital structure, that debt equity mix that results in the lowest WACC is usually considered optimal because it maximizes the firm's value.
Okay, so how do you actually figure out WACC? It sounds complex.
The concept is straightforward, even if the calculation has details. You take the cost of each funding source, common equity, preferred stock, debt, and you weight each cost by how much of that funding the company uses. So if debt is 25% of the capital, its cost gets a 25% weighting.
And you mentioned the after-tax cost of debt. Why after-tax?
Because interest payments are tax deductible. This effectively lowers the cost of debt to the company. So you take the pre-tax cost and multiply it by the tax rate. It makes debt look a bit cheaper.
Got it. Finding that perfect balance, the optimal structure, must be tricky then.
It is, because as you take on more debt, it seems cheaper initially due to the tax shield. But beyond a certain point, both lenders and shareholders perceive more risk. They'll demand higher returns, pushing the cost of both debt and equity up, and eventually increasing the WACC. It's a balancing act.
And things like loan covenants come into play too.
Definitely. Lenders put those in to protect themselves. The more debt a company has, generally, the stricter those covenants become, limiting things like dividend payments or further borrowing.
Makes sense. And all this affects growth and profitability too, right?
Absolutely. Your capital structure influences how much you can reinvest versus paying dividends or interest, and impacts profitability metrics like return on equity through interest expense.
Let's quickly touch on leverage. There's operating and financial.
Yeah. Operating leverage is about fixed costs. High fixed costs mean profits jump around more with sales changes.
Right.
Think factories versus consultants.
Okay.
Financial leverage is purely about using debt. You can magnify your earnings per share when things are good because interest is fixed and tax deductible.
But it also magnifies losses and increases that bankruptcy risk we mentioned.
Exactly. It's a double-edged sword. There's even a concept that the value of a company with debt is its value without debt, plus the present value of the tax savings from that debt.
Wow, okay. So wrapping up, capital structure isn't just some accounting detail, it's really a core strategic decision.
Totally. It affects risk, return, investment decisions, company valuation, pretty much everything financial.
A delicate balance, like you said.
It really is.
Yeah.
And, a final thought to leave folks with. How might a company stage, say, a young, fast-growing tech firm versus a mature utility, change what the optimal capital structure looks like for them? Maybe ways we haven't even touched on.
That's a great question. Definitely something to think about.